It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
And are you waking up in the morning and turning on CNN to just see what is playing out overnight internationally? If you're not doing that, I'm doing it for you, so we'll keep you updated. Trump has certainly fallen out of favour with many of his supporters, including Joe Rogan, who is now constantly criticising him. The worm has turned. What do you think in terms of what all of this means and what is going on around the oil crisis and the economy? You can let us know with your voice message in the show notes. It's quick and easy to use, or you can email us anytime at myrealestatepodcast@gmail.com. Lenders, they are discounting variable and fixed rates for strong borrowers. A lot of people might be wondering, what makes a strong borrower these days?
Yeah, we are seeing some good discounts being offered for variable rates, but as you say, it is very much around the character or the criteria of the borrower. What I mean by that is the providers will be looking at the loan amount, but probably as importantly, they'll be looking at the loan to value ratio. So what we're finding is the lower loan to value ratio, if it's 60 or 70% or 50%, we are getting some pretty good variable discounts on those, which is making it quite attractive and creating some opportunities for clients who might be with a provider where the rates on the variable loan are stuck on over 6. Fixed rates are pretty set and forget. There are a couple of interest rate rises away from the variables at the moment.
Now, we have spoken before about the ever-increasing speculation around changes to capital gains tax and negative gearing ahead of the federal budget. It's creating nervousness, especially with investors who some are in pause mode. They're just waiting to see what the outcome of this is going to be. Now, the argument is that reform could improve affordability, while critics warn that it may reduce rental supply and investor confidence. So let's talk through this on the basis that the changes proceed. And on that basis, how could property investors be affected? And what ripple effects might we see across the broader housing market?
Yeah, look, I think the biggest issue for property investors right now is probably not interest rates, it's these potential changes. And that has created a certain caution. Just to quickly recap, what the government's talking about bringing in the budget is decreasing the capital gains tax concession from 50% to either 33% or even 25%, an asset held for more than 12 months, and also potentially limiting negative gearing to just 2 investment properties. We got to remember 70% of investors are mum and dad investors building their wealth accumulation. Look, I think there's a couple of sleepers here. I'll give you a couple of examples of how this may impact the market. Rentvestors is a way for first-time buyers to get into the market, to buy an investment property with the idea that they will flip it or sell it within a couple of years and then buy a home, leverage themselves into a home. That could well impact the stock of rental properties. We're also seeing a lot of people with maybe 2 investments may cap their investment properties. So that may limit landlords growing a portfolio and creating more stock. Another risk is potentially that some of these costs, because obviously the 2 key things for the investors are capital growth and rental return, are passed on to renters. There may be some stock freed up, but I think we're going to see a flow-on effect to renters in an already incredibly difficult and unaffordable rental market.
And as we mentioned last week, the March quarter is around that 9.9%. It's its strongest number since 2022, yet beneath the headline numbers, Sydney and Melbourne are cooling, while Perth, Brisbane and Adelaide, they continue to outperform. Global uncertainty is creating an anxiety for all sorts of reasons. You know, it's affecting everyone and impacting on how people can move forward with confidence. And we know that real estate is all about how confident you might be feeling. So let's look at what is driving national growth right now. And is the momentum that we're currently seeing sustainable, do you think?
Yeah, it's counterintuitive, isn't it, really, that we're at 9.9% growth over the last 12 months. It very much is a two-speed market at the moment. We're seeing the sub 1 million properties or the properties below the 5% deposit scheme are really, really having strong growth. It's up 6.7% over the last quarter compared to across other markets of 3.6%. So that sub 1 mil particularly is really strong with first home buyers and investors. The other thing is that there are some regions still going very, very strong. 12-month regional growth, that's outside the major capitals, was up 11.7%. That is sheerly driven based on affordability, no doubt about it. Whereas the combined capitals are only up 9.3%. So we're seeing a lot of growth in the regionals. I think underpinning our growth is supply. We have got supply shortages in Perth, Adelaide. Every capital city has a chronic supply issue, number one. And number two is the other issue is these migration levels, and we cannot sustain the level of migration and actually physically build the number of houses we need.
Let's fuel your passion for property together. Join us, along with our industry experts, to help inspire and inform your next real estate decision.
When it comes to apartments, strata buildings and developments, who really owns the building data today, and why has that become such a major issue for owners and investors?
In terms of ownership, I think everyone would argue that the building data does belong to the owners. However, how it is maintained, accessed, stored, that's where lines get grey and where the information becomes less valuable and less useful. Because that information has traditionally sat with the management teams, and because management teams inevitably change, that data seems to find itself in USBs, Google Drives, where an entirely new building performance needs to be kind of spun up the next time that information, someone is able to access that information to begin a new era of looking after the building. Our concept is to really look and learn from finance and focus back on the people that are delivering the service. We are not replacing the humans. That's the most important point to make, is that the client relationships are critical to good building maintenance and management.
Yeah, no, good point. And traditionally, developers finish construction and hand over with the keys to the owners. How are smarter developers then now rethinking the handover as a long-term value proposition, perhaps rather than just the final step of construction?
Oh, I think this is completely transforming, and we are seeing some phenomenal developers and builders right here in Canberra that we're working with who are recognising that from a reputational perspective, they are building beautiful properties and they want them looked after. So they don't just want to throw the keys at the manager and walk away. This is their brand. This is the property that they've built from the ground up. And so they're looking at programs like ours and gifting them to the property owners as part of handover. So we are taking all of their thousands of documents, their plans, their warranties, their maintenance schedules, their future periodic inspections. We are putting those all into a system that's easy to access and navigate, that the executive committee of the building, so the representatives of the owners corporation, have just as much access to that information as the building managers do, which means that everyone's on the same page and it's all very transparent. The builder can access the defect register in real time. We have a system where we fit QR codes to the building, and individual unit owners can push their defects back so that builders have really rich information on trends, which is very important for their next build and being able to assess their current contractors. So builders are seeing this as a long-term investment and a gift to the owners corporation to say, we're going to elevate the way that we are maintaining this building moving forward, which is inevitably going to save you money.
Ready to take your real estate knowledge to the next level? So are we.
Right across Australia, rental pressures and affordability challenges. We know that they are pushing more people towards flexible and lower cost accommodation options. Investors are also searching for stronger cash flow models. What demand trends then are you seeing right now, and where is it heading to next?
Yeah, look, I mean, it's not a trend that's only just appeared. You know, I've been watching census data from the early 2000s, and we've got a mismatch in the property market cycle right now. And that mismatch is that 80% of all new construction is basically 4-bedroom houses. And at the same time, 80% of all new households that are entering in the market ready to rent a property are single or couple households. So in Australia, the trend is that we're building larger homes with more bedrooms for the people that need it the least. The 80% of the market that wants to rent a property is actually a single or couple. And so while we're building these large family homes, we've got these family sizes getting smaller and smaller. So the demand right now is the mismatch, and we all know mismatches, Airbnb and Amazon and Netflix. Someone needs to fix that marketplace, and that's the trend that's happening now, and you can fill that market really quickly.
Yeah, because I've seen these videos, and maybe it was one of your projects, in fact, where somebody's converted a house, and it might be a 4-bedroom, might be a 5-bedroom property, and they've set them up as completely separate. Like they've got the little kitchenette in there. There's no stove, oven, etc. But I think you can make yourself a cup of tea. You know, if you're going to eat, probably you're going to order food that you can put in your little refrigerator. And then maybe there is also a sort of a general area where people can share a larger kitchen. Is that the sort of thing you're talking about?
Yeah, absolutely. And it probably was our conversion. We did a 48-hour conversion, so 12-hour days, 4 days, and we converted a 3-bedroom, 2-bathroom, multiple living area property that was about 50 years old into 6-bedroom, 6-bathroom, 6-kitchenette, 2 main kitchen properties, and fully furnished it in the 48 hours. And each person has their own sitting area, their own courtyard, their own bathroom kitchenette, and they get to share the common kitchen and laundry, but they don't really go to the common kitchen because they've got an induction stove, a microwave.
Yeah, so alternative housing models, which is exactly what you're talking about, can sometimes also improve the returns when structured correctly. So from your experience, what is separating at the moment a sustainable high yield strategy from one that simply looks good on paper? And I think there's a lot of those that look good on paper, but they don't necessarily translate that way.
Yeah, absolutely. And so the beauty with what happened with me was I was a big block developer, and I just had a really sad time in my life, and I needed something different. I went looking for something that was going to provide and continue to be able to build a property portfolio, but that was actually going to help the community at the same time. And I went for cash flow strategies, and everything I looked at was either regional or was high risk or it was mining, and I didn't want to do that. So I wanted growth and I wanted cash flow, but they've always said you can't do growth and cash flow in the same deal. And here I found unknown, unused policies across the country, which could make a very big difference. And so I started buying capital, good growth properties in good metropolitan areas, and I was able to sustain cash flow by providing more. And it's sort of like playing Monopoly, right? You want to buy on the best street on the Monopoly board, and you want to buy a hotel equivalent, which has multiple rent strategies. And then that way you're actually getting the best of both worlds.
It's the Real Estate Podcast.
The recent data, it does show that Melbourne's values slipping again, marking those multiple consecutive months of mild declines. It's not a collapse, we should say that, stress that. It is more of a market pause driven by these higher rates, affordability pressures and cautious sentiment. Sentiment is everything when it comes to real estate. I just want to come back to, the buyers. They've definitely got more time. That is what most people seem to be telling us, Jeff. More time to transact, and probably put some more of those clauses in the agreement that, you go back not that long ago, you couldn't get.
No, that's right. Buyers are very, very hesitant at the moment to act swiftly. That's been a very noticeable change. I spoke to 9 prospective new clients just in the last 2 weeks. All 9 of them are just sitting on the fence and have not engaged me. Previously, I would have 95% of them engage me on the spot. So there's no sense of urgency. There's no sense of panic. There's definitely fewer buyers on the ground. Agents are telling me that most of the auctions they've got have got 1 or 2 potential bidders versus 3 months ago, you'd have 5 or 6. So it's definitely a buyer's market at the moment. I think what is probably keeping the market reasonably healthy is that prospective vendors are not coming onto the market. This is second highest time of the year as far as the volume traditionally, but we're not seeing that in Melbourne at the moment. So I think the shortage of supply is keeping the market pretty steady in the lower price ranges, I'll emphasise.
Yeah, and last time that we spoke, Jeff, we were talking about some of the underquoting, some of the problems in the Melbourne market, and you were finding that extremely frustrating. 2 weeks ago, we did highlight the Joss Tesselin. This is the former high-profile Sydney real estate agent who was banned for 10 years, misconduct that was found, systematic underquoting, dummy bidding, falsified documentation. And also one of the other things was high-pressure sales tactics. And I wanted to talk to you about that this morning because some people might not realise just exactly what that was when it came to Josh Tesselin.
Yeah, sure. Look, the high-pressure sales techniques commonly used throughout Melbourne, and most of the agencies and principals train their staff to do exactly this. The majority of properties in the inner suburbs of Melbourne are actually auctions, not private sale. That has swung around a lot in the last 4 weeks. The buyers that are probably a little bit gullible or not familiar with the way it works is they'll have a look at a property, they'll ask the agent that's booked an auction in 4 weeks' time, they'll ask them whether they're open to offers prior to auction. The agent will say, well, sure, if it's a good offer, we'll certainly put it forward. They're open to offers. They secretly know they're not going to take any offer before auction. That's just a sales ploy to underpin the market, to get somebody to table an offer. Then they'll decline it the next day. Sorry, the owners have decided to go to auction. And then they'll use that offer to leverage other buyers. The buyers are all feeling that there's someone else breathing down their neck. And I guess the fear of loss is probably the biggest emotion I think we've got. Once you've taken something away from somebody who wants it, they tend to go into panic mode. And that's generally what happens. Mysteriously, there's always another buyer that pops up once you make an offer. What they don't explain to you is that offer or the other buyer might be substantially below the figure that you've offered and substantially below the number that the vendor is expecting. They won't go into that detail, but they certainly use your initial verbal offer to leverage that against you, yeah.
We talk constantly about the unit market, which, if you look at Melton South, you can get into a unit there for $325,000. That ain't bad.
Yeah, look, it's exceptional. And again, I have been recommending to clients, the investor clients, to buy single level units. A lot of buyers get confused with townhouses, 2-story townhouses. They think that they're units. They're not. They're townhouses. That's a market in itself. Single level units have been, I think for the first time in 40 years, have outpaced house appreciation by 8% in the last 12 months. And I think that's primarily due to the ageing population and the fact that people still want their independence. Units are a fantastic, you've still got your independence, your freestanding. There's not necessarily a large body corporate or owners corporation. And of course, you still get a good, generous size garden allotment to have the dog run around or plant some veggies or have a little garden, which is what most people approaching retirement are looking for.
We connect you to the best real estate information across Australia. The Real Estate Podcast.